Ladies and gentlemen, Asian guy here. I hope you are sitting down. I hope you are somewhere quiet where you can actually hear what I am about to say, because the mainstream media is not going to tell you this. They are going to tell you about the stock market hitting new highs. They are going to tell you about political drama and election cycles. They're going to tell you that the economy is soft landing. It is all noise. It is all a distraction designed to keep you looking at the puppet show while the theater burns down. Today, we are not talking about charts. We are not talking about moving averages. We are talking about the single most terrifying number in the history of global finance. We are talking about the debt ceiling death spiral. I want you to look at the U.S. national debt clock. You can Google it right now. Do it. Watch the numbers spin. It is currently over $34 trillion. That is a 3, a 4, and 12 zeros. It is a number so large that the human brain actually shuts down when trying to comprehend it. We are not evolved to understand trillions. So let me break it down for you. If you spent $1 every single second, it would take you 31,000 years to spend $1 trillion. We are $34 trillion in the hole. That means we have spent the equivalent of over 1 million years of accumulated wealth that we do not have. And here's the kicker. We aren't paying it back. We aren't even trying to pay it back. The financial media treats the debt ceiling like a political game. They say, oh, Congress will fight. They will threaten a shutdown, and then they will raise the limit. And they are right. They will raise the limit. They have raised it 78 times since 1960. But they are missing the mathematical reality that has just shifted beneath our feet. For 40 years, interest rates were falling. This allowed the U.S. government to borrow more and more money. But the cost to service that debt, the monthly credit card payment, stayed relatively low. It was free money. It was a party. The politicians bought votes with printed cash, and the bill never came due. But the party is over. The lights just turned on, and the cockroaches are scattering. We have entered a new era of interest rates. The Federal Reserve raised rates from 0% to over 5% in the fastest hiking cycle in history to fight inflation. But they forgot one thing. They forgot that the U.S. government has to refinance its debt. Just like an adjustable rate mortgage, the U.S. Treasury has to roll over short-term bills constantly. They are taking debt that was financed at 0.25% and refinancing it at 4.5% or 5%. The math on this is catastrophic. It is not a linear problem, it is an exponential problem. This is what we call the death spiral. It works like this. The government spends more than it makes, a deficit. It borrows money to cover the gap. It has to pay interest on that borrowed money. But because the debt is so big and rates are now high, the interest payment itself is massive. So where does the government get the money to pay the interest? It doesn't have it. So it borrows more money just to pay the interest on the old money. This adds to the debt, which increases the interest payment next year, which forces them to borrow even more. Do you see the trap? It is a compound interest loop from hell. We are currently adding $1 trillion to the national debt every 100 days. Let that sink in. Every 3 months, we add $1 trillion. It used to take the country 200 years to accumulate the first trillion. Now we do it in a fiscal quarter. This is not sustainable. This is not a theory. This is 8th grade arithmetic. When a system goes parabolic, when it goes vertical, it implies a collapse. There is no other outcome in the laws of physics or economics. The skeptics will say, Asian guy, people have been warning about the debt for decades and nothing happened. And they are right. Nothing happened. Until now. The difference is the interest rate environment. For decades, we could mask the insolvency because money was free. Now money has a cost, and that cost is eating the federal budget alive. We are mathematically past the point of no return. Even if we taxed every billionaire in America at 100%, even if we cut all discretionary spending to zero, we still cannot balance the budget. This brings us to the core of today's emergency broadcast. The U.S. government is technically insolvent. If this were a corporation, it would be in Chapter 11 bankruptcy. If this were a household, the bank would have foreclosed on the house and repossessed the car. But because it is a sovereign government with a printing press, they have one get-out-of-jail-free card remaining. They can print the difference, but printing the difference doesn't fix the problem. It shifts the default. There are only 2 ways a government can deal with a debt load this unpayable. Option A, hard default. They walk up to the podium and say, sorry, we aren't paying the bonds. Anyone holding U.S. treasuries, you get 0. This would trigger a global depression, collapse the banking system, and start World War III. They will never, ever choose option A. That leaves option B, soft default. Soft default is a fancy term for inflation. They will pay back the debt, I promise you. If you own a bond, you will get your dollars back. But those dollars will be worth pennies. They will print the trillions needed to service the debt, flooding the system with new currency. They will dilute the value of every dollar in your savings account to save themselves. They are choosing to burn your purchasing power to keep the government lights on. This is why the debt ceiling debates are a farce. The ceiling doesn't matter. The floor is falling out. The trajectory is set. We are witnessing the end of the 100-year debt supercycle. And in this environment, holding US dollars is not safe. It is a guaranteed loss. The dollar is the liability of a bankrupt entity. Gold is the asset of no one's liability. The divergence between these two assets is about to become the defining financial event of our lifetimes. I need you to focus on a specific line item in the US Treasury budget. It's usually buried on page 50, but right now it is screaming from the front page. It is called net interest on debt. This is the money the government pays to bondholders just to keep the scheme going. It buys no tanks, it builds no bridges, it pays no doctors. It is dead money. It is the cost of past mistakes. For the first time in history, the interest payment on the U.S. national debt has crossed $1 trillion annually. To put that into perspective, we now spend more on interest payments than we do on the entire U.S. defense budget. Think about that. The United States maintains 750 military bases globally, operates 11 aircraft carrier strike groups, and funds a massive intelligence apparatus. And yet, the bankers and bondholders are now costing us more than the entire military-industrial complex. We are spending more on interest than we spend on Medicare. We are approaching the point where interest will be the single largest line item in the federal budget, surpassing Social Security. This is what we call a Minsky moment. It is the point where the cash flow generated by an asset is no longer sufficient to service the debt on the asset. The United States is now a zombie borrower. We are borrowing from Peter to pay Paul, and then borrowing from Mary to pay Peter. Let's look at the mechanics of why this is accelerating. The U.S. government has a massive wall of debt maturing in the next 12 to 24 months. Over $7 trillion of government bonds are coming due. These bonds were issued 2, 3, or 5 years ago when rates were near zero. When a bond matures, the government has to pay back the principal. But they don't have the cash, so they issue a new bond to pay off the old bond. Here is the disaster. They are replacing a bond that paid 0.5% interest with a bond that pays 5.0% interest. That is a 10x increase in the cost of capital. Imagine if your mortgage payment went from $2,000 a month to $20,000 a month overnight. Could you afford it? No, you would default. The US government is facing that exact scenario on a multi-trillion-dollar scale. Every day that passes, more cheap debt matures and is replaced by expensive debt. This pushes the interest bill higher and higher, regardless of what the economy does. The Congressional Budget Office, the CBO, releases projections that are laughable. They assume no recessions for the next 10 years. They assume modest interest rates. And even in their fantasy scenarios, they project the debt to GDP ratio hitting 120%, 130%, 150%. But if we plug in real numbers, if we assume a recession hits and tax receipts fall, the model breaks, the line goes vertical. Why does this matter to your gold and silver? Because the bond market is the competitor to gold. For 40 years, investment advisors told you, don't buy gold. Gold pays no interest. Buy a U.S. Treasury bond. It is risk-free and it pays you a yield. That was true when the government was solvent. But today, that U.S. Treasury bond is return-free risk. The bond market is waking up to the math. This is why we are seeing volatility in the Treasury market. The bond vigilantes are sniffing out the insolvency. They are asking a simple question. If the U.S. government has to borrow $2 trillion a year just to keep the lights on, who is going to lend them that money? China isn't buying anymore. They are selling. Japan is struggling to defend their own currency. They are selling. Saudi Arabia is moving to the petro-yuan. They aren't buying. So, who is the buyer? Who is the patsy at the poker table? There's only one buyer left, the lender of last resort, the Federal Reserve. This brings us back to the death spiral. Since there is no natural demand for this exploding supply of debt, the Federal Reserve will be forced to step in and buy the bonds. This is called yield curve control or quantitative easing. They will use printed money to buy the government debt to keep interest rates from exploding. But when the Fed buys the debt, where do they get the money? They click a button, they create it from thin air. This increases the money supply. This dilutes the currency. This is the engine of inflation. The interest payment crisis guarantees that the money printer must be turned on and left on. They cannot turn it off, or the government defaults. So when you look at gold, do not look at it as a rock that sits in a vault. Look at it as the only financial asset that is not someone else's liability. A treasury bond is a promise that the government will tax future generations to pay you back. But the math says they cannot tax them enough. The math says they must print. Therefore, the treasury bond is a contract for guaranteed debasement. You are guaranteed to get back dollars that buy less than they do today. This is a mathematical certainty. It is not an opinion. The deficit is 6% of GDP while the economy is technically growing. That has never happened before. Usually, deficits shrink during growth, and we are running wartime deficits during peacetime. Now, why? Because the interest payments are consuming everything. We are witnessing the fiscal collapse of the empire. It doesn't happen overnight with an explosion. It happens slowly, like a cancer, eating away at the value of the currency until one day confidence breaks. And when confidence breaks, the move out of dollars and into hard assets will be violent. The math proves that the dollar must fall. And since gold is priced in dollars, the math proves gold must rise. Not because gold is changing, but because the denominator, the dollar, is crashing towards its intrinsic value, zero. We need to talk about Jerome Powell and the Federal Reserve. They are trapped in a box of their own making, and the walls are closing in. The media portrays these central bankers as wizards, as omnipotent masters of the universe, who can steer the economy with a dial. But the reality is, they are driving a bus with no brakes down an icy mountain, and they have to choose between driving off a cliff or crashing into a wall. Here is the dilemma. And it is crucial you understand this, because it dictates the future of your savings. The Federal Reserve has a dual mandate: stable prices, low inflation, and maximum employment. To fight inflation, they must raise interest rates and stop printing money. We saw them do this in 2022 and 2023. They jacked up rates to try and kill the inflation monster they created. But here's the trap. When they raise rates to fight inflation, they bankrupt the US government. As we discussed in part 2, higher rates mean the interest payments on the $34 trillion debt become unpayable. Higher rates also crush the banking system, as we saw with Silicon Valley Bank. The banks are holding trillions in treasuries that lose value when rates rise. So if the Fed keeps rates high to save the dollar, they destroy the government and the banking system. So what is the other option? They can cut rates, they can turn the money printer back on. They can perform quantitative easing to lower the government's borrowing costs and save the banks. But if they do that, what happens to inflation? It explodes. It doesn't just go back to 3% or 4%, it goes to 10%, 15%, 20%. We enter a 1970s-style stagflation, or worse, a hyperinflationary spiral. This is the definition of fiscal dominance. Fiscal dominance happens when the government's debt is so large that the central bank loses its independence. The Fed can no longer focus on inflation. It must focus on keeping the government solvent. The fiscal policy, debt, dominates the monetary policy, rates. History tells us exactly which path they will choose. There's not a single example in 5,000 years of recorded history where a government voluntarily chose to default and declare bankruptcy to save the currency. Not one. They always choose inflation. They always choose to print. Why? Because inflation is a hidden tax. It is easy to sell to the public. They can blame greedy corporations. They can blame supply chains. They can blame Putin. It is complicated and confusing. A hard default is simple and painful. So the Fed is bluffing. They are talking tough about higher for longer. They're acting like they will fight inflation to the death. But the moment something breaks, the moment the treasury market seizes up or a major bank fails, they will pivot. They will fold. And the market knows it. This is why gold is hovering near all-time highs despite high interest rates. In a normal world, high rates are bad for gold. But this is not a normal world. The gold market is looking ahead. The smart money knows that the Fed's tight monetary policy is a temporary anomaly. The long-term reality is infinite liquidity. We are seeing the early signs of this pivot right now. The Fed is already talking about rate cuts. Why? Inflation is still above their 2% target. Why are they cutting? Because the system is cracking. The commercial real estate market is imploding. The regional banks are on life support. The Fed is being forced to prioritize financial stability over price stability. This is the green light for gold. This is the signal that the put option is in play. The Fed essentially has a standing order to debase the currency whenever the pain gets too great. Think about the psychology of this. If you know that the central bank creates money to bail out mistakes, why would you hold cash? Cash is the asset that gets diluted to pay for the bailout. You want to hold the asset that cannot be printed. You want to hold the asset that has no counterparty risk. The skeptics will say, but the dollar is the strongest currency in the world. It is the cleanest shirt in the dirty laundry basket. This is the milkshake theory. And yes, against the yen or the euro, the dollar might look strong for a moment. But that is like being the tallest dwarf. All fiat currencies are sinking relative to real assets. The euro is dying. The yen is collapsing. The dollar is just collapsing slower. But do not confuse relative strength with absolute value. When you go to the grocery store, do you pay in euros? No, you pay in dollars. And your grocery bill is up 30% in 3 years. That is the dollar collapsing against beef, against eggs, against energy. That is the only metric that matters. The Fed creates the illusion of stability while stealing your wealth. They aim for 2% inflation. Do you know what 2% inflation means? It means they plan to cut the value of your money in half every 35 years. That is their goal. That is success. But with the debt spiral, they won't hit 2%. They will run hot. They have to. They need inflation to be higher than interest rates to burn away the real value of the debt. This is called financial repression. They are stealing purchasing power from savers to pay off the debts of the borrowers, the government. If you hold dollars, you are the victim of this heist. If you hold gold, you have opted out of the system. You have become your own central bank. The math dictates that the Fed must expand the balance sheet. They must monetize the debt. Whether they call it not QE, or market support, or bank term funding program, it is all the same thing. It is counterfeiting. It is diluting the share count of the US dollar. Gold is the share buyback. Gold is the asset that gets scarcer while the dollar gets infinite. There is a phrase that history rhymes. But in economics, history doesn't just rhyme, it repeats with the precision of a Swiss watch. We act like the American experiment is immune to the laws of financial gravity. We have American exceptionalism. We have the reserve currency. We have the aircraft carriers. But Rome had the legions. The British Empire had the navy. No empire can defeat math. I want to take you back to Rome. The denarius. It was the reserve currency of the ancient world. It was pure silver. But the Roman emperors wanted to spend more money. They wanted more wars, more public works, more bread and circuses to keep the people happy. But they ran out of silver, so what did they do? Did they cut spending? No, they clipped the coins. They mixed the silver with copper. They debased the currency. At first, nobody noticed. The coins looked the same, but over time, the merchants realized the coins were trash. Prices skyrocketed. The soldiers demanded higher wages because the money was worthless. The economy collapsed and the empire fell. Fast forward to Weimar Germany, 1923. Germany had massive war debts denominated in gold marks. They couldn't pay, so they printed paper marks to buy foreign currency to pay the debt. It started slowly, then it went exponential. People were taking wheelbarrows of cash to buy a loaf of bread. The middle class was wiped out in months. The savings of a lifetime couldn't buy a cup of coffee. Fast forward to today, the United States. We are doing the exact same thing, but we are using digital ledgers instead of copper clippings or printing presses. When the Federal Reserve buys treasury bonds with money that didn't exist 5 seconds ago, that is coin clipping. That is debasement. The scary part is the speed. In Rome, it took 200 years to destroy the currency. In Weimar, it took a few years. In the digital age, confidence can evaporate in seconds. We live in a world of high-frequency trading and 24-hour news cycles. When the realization hits that the U.S. debt is unpayable, the rush to the exits will be instant. We are seeing the bond market signal this reset. Bonds are supposed to be the risk-free asset. But in 2022, the 30-year U.S. Treasury bond lost nearly 50% of its value. That is a crash that rivals the dot-com bubble or the 2008 housing crisis. But it happened in the safest asset in the world. Why? Because the market realized that the inflation risk is permanent. If you buy a 30-year bond paying 4%, but inflation averages 5% or 6%, you are locking in a guaranteed loss of purchasing power for 3 decades. Who would sign up for that deal? Only a fool or a central bank. This is why we say bonds are return-free risk. And this is why the traditional 60-40 portfolio is dead. For 40 years, your financial advisor told you to put 60% in stocks and 40% in bonds. The bonds were supposed to protect you when stocks fell. But in the debt spiral scenario, stocks and bonds fall together. Stocks fall because the economy slows, and bonds fall because inflation rises. There is nowhere to hide in the paper markets. This historical cycle is called the sovereign debt crisis. It happens when the state becomes the biggest risk to the economy. We are there. We are watching the credibility of the U.S. Treasury dissolve in real time. Look at the downgrades. Fitch downgraded U.S. debt. Moody's put it on negative watch. These agencies are usually years behind the curve, but even they can't ignore the math anymore. They are telling you that the full faith and credit of the United States is waning. So, what happens next in the historical roadmap? Financial repression. The government will force institutions to buy the debt. They will change the rules. They will tell pension funds, you must hold 50% of your assets in treasuries. They will implement capital controls to stop you from moving money out of the country. They will launch a central bank digital currency, CBDC, to track every transaction and prevent you from exiting the system. This is not a conspiracy theory. This is the playbook. It is what happened in Argentina, in Lebanon, in Turkey. When the government goes broke, they lock the doors. They trap the capital inside to burn it. Gold is the escape hatch. Gold is the asset that exists outside the system. It is not on the government's ledger. It is not dependent on the electricity grid. It is the only asset that has survived every currency collapse in history. When the Weimar mark went to zero, an ounce of gold still bought a suit, a house, a farm. In fact, it bought more because the chaotic value of paper made real assets incredibly valuable. We're approaching a reset. Some call it the Great Reset. Some call it a jubilee. But math demands that the debt be wiped out. It will either be wiped out by default, destruction of the bondholder, or by inflation, destruction of the currency holder. Since the US voters and politicians will never accept a default that stops the welfare checks and the war machine, they will choose inflation. They will choose to destroy the currency. This means we are heading for a period of high volatility where the price of everything, food, fuel, housing, gold, skyrockets in dollar terms. But do not be fooled. The house isn't getting better. The gold isn't changing. The dollar is just getting smaller. You are holding a ruler that is shrinking. Last year the ruler was 12 inches. Now it is 11 inches. Next year it will be 9 inches. If you measure your wealth with a shrinking ruler, you will feel rich. Oh look, my house is worth $1 million. But if a loaf of bread is $20, are you actually rich? This is the money illusion. Gold breaks the illusion. Gold is the constant. An ounce of gold in Roman times bought a nice toga and a pair of sandals. Today, an ounce of gold, 2,300, buys a nice suit and a pair of shoes. It has preserved wealth for 2,000 years. The dollar has lost 98% of its value since the Federal Reserve was created in 1913. The math says the final 2% is about to go. I want to address a psychological barrier that hurts so many investors. I hear it every day in the comments. Asian guy, I missed the boat. This is the most dangerous mindset you can have during a currency collapse. You are looking at the nominal price. You are looking at the number on the screen. You are suffering from unit bias. You think $2,000 is a lot of money because 10 years ago it was a lot of money. But $2,000 today is not $2,000 from 2010. Let's do the math on real highs. In 1980, gold hit $850 an ounce. That was the peak of the last great inflation crisis. If you adjust that $850 for the official CPI inflation, which we know is a lie, but let's use it anyway, the inflation-adjusted high for gold would be over $3,200 today. If you use the real inflation numbers, the way they calculated it in 1980, gold would need to be over $10,000 an ounce just to match its 1980 purchasing power. So at $2,300 or $2,400, gold is not at an all-time high. It is cheap, it is historically undervalued, it is trading at a discount to the money supply. We need to look at the gold to debt ratio. This is a chart that divides the price of gold by the US national debt per capita. Every time this ratio hits a low, it is a generational buying opportunity. Right now, the amount of debt created per ounce of gold is off the charts. The supply of dollars and debt has gone vertical, but the price of gold has only crept up slowly. This is a coiled spring. This is potential energy waiting to turn into kinetic energy. Think of it like a beach ball held underwater. The water pressure is the manipulation, the tamp downs, the paper derivative contracts on the COMEX. But the air in the ball is the fundamental reality of the debt. The deeper you push the ball, the more debt you print, the more force it has when it inevitably breaches the surface. When that ball is released, it doesn't just float to the surface, it rockets into the sky. We are seeing the everything bubble. Stocks are in a bubble. Real estate is in a bubble. Crypto is in a bubble. Why? Because the currency is broken. When money is trash, people buy anything just to get rid of the cash. This is called the crack-up boom. It is the final phase of a currency collapse. But here's the distinction. Stocks and real estate are dependent on the economy and credit. If interest rates stay high, real estate crashes. If the consumer runs out of money, corporate earnings crash. But gold is not an investment in the economy. It is an insurance policy against the economy. It is a short position on the Federal Reserve. When the everything bubble bursts, capital will flee from risk assets. It will look for safety. It will look for liquidity. It will look for something with no counterparty risk. Currently, less than 0.5% of global financial assets are allocated to gold. 0.5%. It is a rounding error. The pension funds, the hedge funds, the 401ks, they own practically zero gold. They own Apple, they own Nvidia, they own bonds. What happens when the bond market breaks and the realization of the debt-death spiral hits the mainstream? What happens if that allocation shifts from 0.5% to just 1%? It doubles. If it goes to the historical average of 3%, the demand for physical metal would overwhelm the supply by a factor of 10. There isn't enough gold at $2,000 to satisfy that demand. The price must rise to balance the market. We are talking about $5,000, $8,000, $10,000 gold. Not because gold is magical, but because the dollar has to devalue to that level to make the debt solvent. The US government actually wants higher gold prices, even if they won't say it. Why? Because they hold 8,000 tons of gold in Fort Knox, allegedly. If gold goes to $10,000 or $20,000 an ounce, the value of their reserves increases. It allows them to repeg the dollar to gold at a much higher price, effectively wiping out the debt. This is how the system resets. They revalue gold to cover the paper. If you are holding paper when that revaluation happens, you lose. If you are holding gold, you participate in the reset. Do not let the high price scare you. The price is merely a reflection of the debasement that has already occurred. The market is just lagging the reality. Look at the Dow Jones to gold ratio. In the Great Depression, it went to 2:1. In the 1980 crisis, it went to 1:1. Today, even if the Dow crashes 50% to 19,000, gold would still need to go to $19,000 to reach parity. The upside potential for gold is asymmetric. China is buying, Russia is buying, Poland is buying, Singapore is buying. They are buying at all-time highs. Why? Are they stupid? Do they like losing money? No, they know the debt spiral is terminal. They are exchanging unbacked US debt coupons for hard money before the music stops. You should follow the whales. Don't listen to what the Fed says. Watch what the central banks do. They are de-dollarizing. They are stacking bullion. They are preparing for a world where the US Treasury bond is no longer the pristine collateral of the financial system. So, when you see gold hit $2,500, then $3,000, do not sell. Do not think, I made a profit. Think, my insurance policy is paying out because the house is burning down. You don't cancel your fire insurance while the living room is on fire just because the premium went up. You hold until the fire's out. And this fire is just getting started. So, here we are at the end of the road. We have looked at the math. We have seen the $34 trillion debt. We have seen the $1 trillion interest payments. We have exposed the Federal Reserve's trap. We know the history of empires collapsing. Now, the question is, what do you do about it? This is not about fear-mongering. This is about preparation. When a hurricane is coming, you don't panic. You board up the windows and buy water. The debt ceiling death spiral is a financial Category 5 hurricane. It is inevitable. It is already offshore. The winds are picking up. The end game will likely play out in phases. Phase 1 is denial. We are here now. The media ignores the debt. Politicians pretend they can cut spending. The stock market parties on liquidity fumes. Phase 2 is acceleration. This is when the bond market breaks. Yields spike. The Fed is forced to intervene with explicit yield curve control. They cap rates, and the dollar starts to slide aggressively. Inflation ticks up to 6%, 8%, 10%. People start to notice their grocery bills hurt. Gold breaks out to new highs, 3,000 plus. Phase 3 is panic. This is when the public wakes up. The trust breaks. People realize the inflation isn't transitory. They realize the debt is unpayable. We see a rush out of the dollar and into anything tangible: commodities, land, art, and precious metals. This is the crack-up boom. You could see gold move hundreds of dollars in a single day. Silver could pull a GameStop and double in a week as the physical shortage meets monetary panic. Phase 4 is the reset. The government steps in. They might issue a new currency. They might revalue gold. They might launch a CBDC and outlaw cash. This is the moment where wealth is either transferred or destroyed. If you are holding the old paper, you get wiped out. If you are holding real assets, you survive to the other side. Your strategy must be simple and robust. You need to get out of the blast radius. The blast radius is the banking system and the bond market. First, you need physical insurance. Not a gold ETF, GLD, not a silver mining stock. Those are financial claims. In a systemic collapse, the stock market can close, brokerages can fail. You need metal that you can hold in your hand. If you cannot touch it, you do not own it. You are merely a creditor to a bankrupt institution. Build a position in physical gold and silver. How much? That depends on your net worth, but the standard 5% allocation is a joke in this environment. You need enough to sleep at night. For some, that's 20%. For others, it's 50%. Remember, this is your savings account. This is the money you cannot afford to lose. Silver offers the greatest leverage. As we discussed in previous scripts, the gold to silver ratio is roughly 85.1 or 61, depending on the day. Geologically, it is 8.1. Historically, it is 15.1. Second, get out of debt. Variable rate debt is a killer in a rising rate or inflationary environment. Pay off the credit cards. If you have a fixed rate mortgage at 3%, keep it. That is an asset. The inflation will pay off that mortgage for you. But any debt that can adjust upward must be eliminated. Third, diversify your jurisdiction if possible. If all your wealth is in one country, in one currency, in one banking system, you are a sitting duck for capital controls. Finally, you must conquer your own psychology. This is the hardest part. The system is designed to make you feel stupid for holding gold. They will mock you. They will call you a gold bug or a doomer. They will point to the S&P 500 hitting all-time highs and say, look, you're missing out. You have to be comfortable being wrong for a long time so that you can be right when it matters most. Michael Burry was wrong about the housing market for 2 years before 2008. He was mocked. Investors pulled their money. Then in 1 month, the world collapsed and he made billions. We are in the Michael Burry phase of the sovereign debt crisis. The math is screaming collapse, but the price action is acting like everything is fine. Do not be gaslit by the market. Trust the arithmetic. $34 trillion growing at $1 trillion every 100 days. Interest payments exceeding defense spending. A Federal Reserve trapped between hyperinflation and default. There is no way out of this room but the door marked devaluation. The wealth transfer is coming. It will be the greatest transfer of wealth in human history. It will move from those who hold paper to those who hold real assets, from those who trust the government to those who trust history, from the oblivious to the prepared. You have the data. You have the warning. The rest is up to you. Do not wait for the news anchor to tell you to buy gold. By the time they tell you, there won't be any left to buy. The debt ceiling isn't a ceiling. It's a coffin lid closing on the US dollar. Make sure you are on the outside looking in, holding the keys to your own financial sovereignty. Merry Christmas, Happy New Year, and for the love of God, check your exposure. Asian guy out.